a full discussion on asset classes. We started with money market instruments. We went on with the capital market instruments, started with the bond market and equity markets. We also have seen derivative instruments. So I also told you how derivatives are different from a pure investment class like money market, bonds, and equities. If it's all good, we can go ahead. If not, you can still ask me a question if you have. Yeah.
Is PowerPoint on Canvas right now?
Yes. Yeah. And there were some errors in the PowerPoints I think I made in the announcements also. I updated it and posted it on the Canvas. Okay. So for this module, we have two topics actually. One is how securities are traded, and the other one is mutual funds. So I divided the first topic, how securities are traded. That is chapter 3 from your textbook. I divided that into how securities are issued, followed by how securities are traded. We'll deal with these two, and after that, we'll go to mutual funds. Okay. So to start with, I think the other way of looking at them is when I'm saying how securities are issued, we are talking about primary markets, and how securities are traded, we are talking about secondary markets. That's the idea. Okay, let's go quickly. Sorry?
The PowerPoint you're on right now, what's it called? I can't find it.
Class PPTs and named it as. Actually, it is a PDF file, I believe. Could anyone of you see that? In module 2?
Yeah.
You can't see that? Give me a minute. Thanks for asking that. It's important. Oh, it's not used. I'm sorry for that. Posted everything and I didn't publish. Just check if you can see that or not right now. Yeah? Good, good. You're good. Okay. So the objective of this topic is my class should know how the companies or the corporations will be issuing the securities. Though we're using the word securities broadly, our discussions are more into equities, shares. So when you look at the firms issuing securities, broadly I classified them into public issues, direct public offers, OTC issues, or we can also call this private issues, direct issues, and direct listing. I'll tell you all of them quickly, but this is what we'll be navigating in the coming 1 hour. So have this picture in your mind. In the end, we'll be summarizing with the same slide. Okay. By the way, did any one of you invest in any of the public issues this year, last year, or your parents or friends are investing in that? No? Okay, try for that. Just check what are the public issues are going on open right now. That would be interesting. Okay. I think let me give this and come back to this, or we can start with this also, not a problem. Here are mentioned as the public issues into IPOs, FPOs, and SPACs. And when we say public issues, the securities in our context, the shares are offered to the general public. Retail individual investors like you and me, institutions, companies, or governments, if they have surplus funds, anyone can invest in this. There are no obstacles, there are no limitations. That's what you mean by public. It's open. So within that, we have, based on the reason why it is offering the issue, I categorize them as primary offer, secondary offer, and mix of these two. Primary offer means the company is raising new capital, issuing new shares. Okay. Why do they issue shares? We discussed in the last session. For capital expansion, buying a company, pay off its debts, existing debts. There could be many reasons why companies need money. Okay. So if the company is issuing a capital for a project, new capital is raised, that we can straight away call it as primary offer. Okay. But there are situations or issues, public issues, where company would be coming for public issue not to issue new shares, but their own internal or insider investors, they want to go out of the company. It could be the promoters or the founders or institutional investors like private equity firms, venture capital firms. They want to exit the company. So what they do is they offer their shares to the public. They take that cash and leave the company. That we call it as secondary offer. So you got the difference, primary offer and secondary offer. So yeah.
What's it about partial equity?
I'm coming to that. So going back to primary offer, there is an equity dilution. Equity dilution is the existing owners are losing their control. New owners are coming, new shares, new owners. So I'll be losing the control if I'm the only owner till now. That's what we mean by equity dilution. Then the last one, both primary and secondary, there are some public issues where they have these two motives. One is to raise new capital, issue new shares, and at the same time, some of the or one of the investors want to leave the company. They are selling their shares to public. Okay, so in the second case, there is an equity dilution, and to some extent, and the other dimension, people are leaving the company. It could be a mix also. Then the public issues where the shares are offered to the general public can be classified as IPOs, FPOs, SPACs, and direct public offers or DPOs. These are the four major categories we can see. So IPOs stands for initial public offer. This is the offer or the public issue by the company for the first time in its life. Means a small company, a private company is making its shares openly available to the public. So that's a first offer by this company. That is the reason we call it as IPOs. If the same company or any other company which has issued shares through IPOs and again coming for public issue, we call it as FPOs. Follow-on public offers, we also call them as seasoned offers or seasoned equity. I think I have more examples, but I'm just introducing quickly. And something maybe interesting, maybe completely new to so most of you is SPAC. This is a kind of investment tool for private companies, investors. They call it as special purpose acquisition companies, SPACs. They're more popular as SPACs. I think 2021s, I think they're of high demand. They're on the news. Their volume is so high. Now it has come a little bit down, but still it is active. So what they do is a private equity firm or a venture capital firm, they offer SPAC. They offer SPAC. So what do? They collect money from the public. Like in IPOs, I told you, they mention why they're raising the money. Capital expansion. What could be the other reason why company makes money from the public?
First stocks.
Yeah, why? Why I'm raising money from all of you by issuing stocks? What is the purpose? What could be the purpose? So if it is a primary offer, secondary offer, I gave you two. Secondary offer means I want to come out of my company and give my shares to you all. This is secondary offer. Primary offer is one is capital expansion, or new projects, tapping new markets, foreign business. For anything, companies require money. Okay. So special purpose acquisition companies, SPACs, they don't mention anything. They don't have anything. It's a kind of a blank space where people are investing in this. And what do they do with that money? Once they find a good company to acquire, they use this money to buy that company, and they clearly state that. Okay, that's what you call it as. We have more discussion on that. Then DPOs. Once we go through the process of IPOs, FPOs, and so on, you will understand the importance of DPOs. DPOs bypass underwriters. There is no intermediary. They want to save some money, save some cost while issuing to the public. So they directly offer to the public. They directly offer the shares to the public. That you call it as DPO. Okay. So these are four major categories within public issues. Then now let us see one by one slowly. Let us know more about each kind of the public issues. Starting with an IPO. So it is not that easy. It is very tough. It is companies have to file their prospectus with SEC, and SEC will take a lot of time on that. And they give the permission for that and give some dates and so on. Then it goes for public. So the first thing is they need to give the full disclosure and description of the issue, which we call it as prospectus. I think the prospectus of any company coming for public issue is available in SEC. There's something called Edgar. Some of you might have seen that. Edgar gives SEC's. Edgar will give you all the details of all the public issues. Okay. So once the shares are offered to the public, it becomes a traded company or publicly traded company. Then how these shares are issued? It is a very difficult process. So I was saying that companies will sell securities underwriters who resell them to the public. What do you mean by that? I know that my company's shares are worth of $100 per share. Okay. But how do I go to the public and raise the capital? That's a big challenge, because the cost of public issue process is very high. To save that, all the companies which are going for public issues, what they do is they go to underwriters. They charge me 5%, 8%, 9%, 10%, or 20%. It all depends on my status, my reputation, my profile, importantly, risk profile. Based on that, he will charge me. Okay. So when I go for that, the IPO itself can be a primary offer or secondary offer based on what I'm saying, how I'm describing my issue. To raise new funds for new shares becomes a primary. If not, it's a secondary. So small issues, I think one underwriter will do to take care of the issue. But the issue size is bigger. There will be a syndicate of underwriters. They want to share the risk related to issuing this. So that's how it usually goes. So not directly to the investors, but through the underwriters. Okay. Then you have there is something called book building. It's a kind of a price discovery. So when you participate in a public issue, when you apply for a company's shares, you're not aware what is the price of the share. So what you will do is there are different methods in this. One is book building, where the institutional investors and other big investors, they discover the price by quoting, going for auction, and retail investors may take the price whatever is fixed in the book building. So that helps, book building helps the issue to have a proper price. So before that, I think underwriters, they themselves take care of promoting it through something called roadshows. I think all the business news channels will be quite active with the headlines promoting the issue. Then I think they reach all the investment banks and so on. That's a process in the roadshow. Now, I think one of my research interests is underpricing and overpricing of IPOs. So if it is underpriced, we call it as a winner's curse. I think the post initial sale returns average 10% or more winner's curse. So what it means is, instead of getting the full price, okay, I don't get the full price because, to start with, most of the research blames on underwriter pricings, but there are other reasons also. So underpricing reflects to the price that I offered and the price on the day of a listing. Generally, it is known as first day trade. First day trade. So I compare issue price with first day price. So I offered for $100 and it is trading for $150. How bad it will be for me as an issuer? Investors will be happy. You got my point? I offered for $100 and it is listed for $150. I feel so bad. Okay, that's what you called as underpricing. It is the other way. If it is the other way, you call it as overpriced. Means I offered for $100 and on the first day it got traded for $70. Okay, these things usually happens based on the underwriters, roadshows, impact of these things, market conditions. Importantly, the market condition is so bad, how good my company is not going to do well. Then related to IPOs, there are important laws and rules related. So first of its kind, it was a post 1930s recession. The Security Act of 1933 gave a proper structure for companies issuing shares in the public. Then IPOs, they all have to go through the Form S1, which is, if you print it, maybe you get 500 or 1,000 pages, maybe more than that. You should give all the information: operational, financial, technical, human resources, customers, suppliers, governance, litigations, whatnot. Everything you have to file there. Then Regulation C, Regulation SEC, as SK, and SEC rule or SEC rule 452. They are more based on your necessities. For example, SEC 452 2009, it gives the price flexibility, and this is more important for FPOs also, because that time you file your prospectus and the day you got permission to go for public issue, there could be a huge gap. By the time your valuation would have changed. So SEC has provided a new provision where you just file it, but price can be flexible. Okay, that was encouraging to the companies. Some numbers based on how IPOs performed on the first day, listing day. Okay, I think we have one. Okay, I think we have more companies, maybe. Yeah, this is European IPOs. I think Greece has the highest of 50%. This is for the period from 1980 to 2022. So 42 years. This is the average, not for one day, one issue. Okay. And if you look at the next slide, this is my interest because this is my strategy. I always select a company which is underpriced. I look at that and pump heavily into it and even borrow money for that and invest it and waiting for the listing day. On that listing day, whatever the price comes, I just exit. Importantly, in the morning hours itself, I come out of it. That was my strategy. So that is how IPOs offer price and IPOs listing price at first day price differs a lot, making a lot of investors like me active on the listing day. Okay. Some of the IPOs in the recent times in US, there are more. I got these three for a differentiation in terms of time.
How does that affect the company underwriters? Like, is there a winner or a loser in that?
It is the shareholder who is the winner or the loser. I mean, if it is underpriced, I feel bad. I'm the loser. If it is overpriced, shareholders will be the losers. In the sense, your shareholders won't feel good. As simple as that. So one issue is in 2011, Duncan's IPO, and Snowflake in 2020, and Astrolabs in 2024 last year. So you can see that I gave you the reason. This is primary. Primary means new capital, new shares are issued. Secondary means there was a PE firm in Duncan. They wanted to go out of Duncan in 2011. Company went for public issue. The whole amount raised from the public was given to this investor, Bain Capital. Okay. There are other investors. I missed it, but he's the big investor. Then Aster Labs, it is also a primary offer because they wanted to raise money for their operations, working capital, and capital expenditures. These are some of the examples in US. Then, so we are done with IPOs. The next one is FPO. FPO means these are the shares issued by a company which is already issued, which is a publicly traded company. It has gone for IPO long time back, maybe last year, maybe 10 years back or 20 years back. But the stock of this company are getting traded. So we call them as FPO issues. Again, why they're issuing? It could be a primary reason, secondary reason. They want new capital or existing investor wants to go out of the company. Can anyone quickly give an example of recent FPO or IPO? Can you search in this year, in this month? Yeah.
4-way or 4-week.
Okay.
They started the IPO at $44, then they shot up to like $1.
Can you tell us quickly, was that a primary offer or secondary? Is primary? Okay, good. Can anyone of you give me an example of secondary offer or mix of primary and second in the recent times? Could you find? You can keep your search on. If you find it, please let the class know. Okay. So FPO issues are not that rigorous as IPOs because through IPO, I already got my record with SEC. Now it is easy for me. So I think it's the same format. There is something called shelf registration for FPOs. They get the process done and keep everything ready. And they wait for the market timing to derive the best price in the offer. So that's what you call it as a shelf registration for FPOs. Okay. So as a process, FPO is quite simple and completely different from IPO, but there are many similarities. So some of the examples I got, I think the latest was Astra Labs 2024. It was a primary offer. Twitter in 2013. This was interesting. Again, PE firm, Bain Capital, want to come out of Twitter. So they came for an FPO in 2013. Then Facebook, it is again a secondary reason. I think this is something different. He wants to come out of it. And Uber 2020, it is again primary. So you have I put a variety of reasons where it clarifies us the offer could be for primary or secondary reasons. SPACs. So these are the issues offered by private equity or venture capital kind of companies who are professionals are dedicated in valuing small firms, startups importantly, or any firm with exponential growth rate. They identify that they'll be part of the companies, they'll be part of the management, they are very close to the founder and CEOs, kind of. It's all mode of entrepreneurship. So these companies attract SPACs. So once I have because there is a competition. If I find a good company, I need money. I can't wait for money to come because the deal will go with someone else. So I want to make myself ready with some amount or desired amount according to my capacity and my risk-taking ability. So I make the SPAC ready with me. Then interesting. Here you have primary offer and secondary offer. Okay, how it happens? Let us see. So the primary thing is just like an IPO, where shares are issued to the public and investors will join SPAC. And in the secondary offer, what happens is the shares on the name of the SPAC will be delisted and it will emerge as a new company with the company where SPAC is acquiring. As simple as that. Okay, so that way we also have primary and secondary within SPAC. We call it as a process of De-SPAC or de-SPACing. So SPAC is no more because all of its money is used to buy another company. So this money will be used to buy the shares of the target company or acquiring company. That's how we use the funds from SPAC. So some examples in the recent times. I think I could get examples in 2025 itself. So Highview raised Highview Merger Corp. The name itself says they are more active in mergers. Did you, in any of the courses, did you go through mergers and acquisitions? Any one of you, any course? Okay. So maybe quickly on that, you might have heard about acquisitions, right? You called as mergers and acquisitions. Mergers is one company getting merged with another company, taking a new name or existing name, diluting the target company's name. Acquisition is a kind of both the companies remain as they are, but my company starts acquiring the shares of that company. That is acquisition. So now the number is good, 200 million, 150 million, 400 million. Yeah. So these are some of the examples. And more examples, the dates I got. This is the IPO date where primary offer is there, public is investing in SPAC, and secondary offer happens when it gets merged with another company, and this is the De-SPAC date, we can say that. Okay. So IPOs. First one was IPO. Second one was, what was the second one? FPO. Third one is DPO or DPOs, direct public offers. And it's not that easy to offer shares directly to the public. Why? What could be the reason? We have seen a lot of struggles in IPOs and FPOs. Now suddenly we are talking about DPOs. Sorry, this is the fourth one. IPO, FPO, SPAC, and DPO. I'm saying that what I'm saying is IPO, FPO, SPAC we have seen, it's not that easy. You need to promote roadshows, prospectors, and so on. Now I'm saying DPO. Why I'm saying it's not that easy compared to IPO or whatever.
You have to make sure all the paperwork is right.
Okay. Correct? Anyone else would like to try? Because in talking about underwriters, I was mentioning why companies go through underwriters. The reason is it's not that easy to make your process successful because it involves a lot of cost. Okay, I don't want to lose that. Number one. Number two, maybe I'm not reputed. I'm telling you the important. I'm not. Let us not talk about FPOs. Let us talk about IPOs. IPOs. I'm not reputed. For the first time, I'm offering the shares. Who knows me? What happens if no one comes forward? I'll be disappointed. And there are a lot of costs involved in this. Okay. So to be successful in DPOs, I think the companies should be very confident and they should have good network. And we should know the process. Although the process should be done, as our friend was saying. It's not that easy. If I'm confident about all these things, yes, I can go ahead. Okay. So here in DPOs, I'm avoiding all the intermediaries, underwriters. I will say underwriting charges or fees. So shareholders get the benefit, I get the benefit. Okay. Some recent issues, Newmax 2025, at least motor vehicles 2025. I think we need to check how strong they were. I think this could be a case study because DPOs are not that easy. Then private placements. This is in contrast to public issues. Okay. We are just talking about public issues, issuing shares to public, underwriters, and so on. And suddenly we are talking about private placements. Why does companies prefer private placements over public? So the reason? Yeah.
Less regulation.
Fantastic. That's one. Anything else? Less regulations?
Ownership. They don't want to give up ownership.
Either way, you're losing the ownership, right? You're issuing the shares. In IPO or private placement, you're issuing the shares, assuming it's a primary offer. Yeah. That is again one important thing. Yeah. Yeah. These kind of things come into the minds of the issuers when they have the choice, when they're indifferent between IPO and private placement. They wanted their firm activities to be closed. Okay. They don't want that to be transparent. If it is an IPO or public issue, things have to be very transparent. More regulation and more participation of the outsiders. Okay, that is a big problem. That makes companies to look at private placements. And again, it is not that easy to get one or few investors to invest in this because you want more money. Say, for example, you want to offer $1 billion to the public. And now we are looking at private placement. It's not that easy. If you want to offer, say, $10 million or $5 million, maybe it's easy for private placement. But $1 billion of private placement is not that easy. Okay. So there is a restriction on this. Yeah, the shareholders, number of shareholders should not be more than 2,000, not number of shares, shareholders. Okay. So it could be 1, it could be 5, it could be 10, it could be 100, not more than 2,000. That is one important thing. So no regulation, they need not be registered. Some examples, I think in the recent times I gave you. I think you can go through there more details if you want, if you're interested to know. Where does this private placements happen? IPOs, public issues, through IPOs, FPOs, or whatever. It happens through underwriters, and there's a whole public place to go through it. But in the case of private placements, it happens through OTCs. Because I need money, I cannot knock all the doors of the investors and try to ask them. So again, for that, there should be a common platform. So investment banks or institutional investors, they take care of this. For example, based on the industry or the sector, I think there are common platforms are there, call them as OTCs. So not only private placements, DPOs to some extent, delisted companies, because they don't meet exchange rules. Exchange SEC prescribes some rules, but in addition, stock exchanges, they also mandate some rules. You have to maintain this. If importantly, the fee, annual fee to be listed, it's not free of cost. All the corporations which are publicly traded, listed in New York Stock Exchange or NASDAQ, they need to pay exchange fee. So if a company cannot afford for that, they will be delisted, but they want money. So they choose OTC. And early stage companies or new companies or startups, they can plan for a public issue. It's very costly for them. There may be some companies, they're struggling for seed capital. Okay. So growing companies require more capital. So that kind of situation makes them opportunities, makes them to tap the opportunities in OTCs. In foreign companies, they also use the OTC issues, over-the-counter issues. That is the other category. Then one more category is direct issues to target investors. Okay, who are these target investors? Existing shareholders. Let's talk about them. A company wants to, why going for public? Company has already gone for an IPO. It is listed and traded. I have my own shareholders. Now I want money. Instead of going for public, I want to offer shares to my own existing shareholders. Why can't I do that? That's a good idea. That saves a lot of time, money, everything. Just now we discussed about IPOs and private placements. So that's a good idea. So when companies offer shares to their own shareholders, we call them as right offerings or rights offer, whatever. I think in your financial management or corporate financial management classes, you have been doing valuations, dividend discount models, Gordon models, theories, and so on. So there you might have dealt with the dividends. Companies will be paying dividends, right? So there will be a situation where companies pay, usually company pay dividends in cash, right? Deposited to your account, bank account, checking account. But sometimes companies may offer stocks instead of cash. So what is happening with that? New shares are getting issued. Number of shares of the company will increase. Okay, new shares are issued. That we call it as stock dividends Then bonus stocks or bonus issue of shares. When companies have had their own dividends accumulated, we had heard about retained earnings. Retained earnings should go for investments. If they are not going for investments fully or partially, they'll be reflected in your reserves account. Okay. So when the reserves account money is there and you don't have any potential projects to do, then companies convert these reserves into stocks and issue to their own shareholders. So again, new issues are coming. That you call it as bonus shares, bonus stock, bonus issue of shares or whatever. Then mergers and acquisitions. I think we discussed about mergers and acquisitions while we are talking about SPACs. That is through public issue. In mergers and acquisitions, when my company acquires another company, we had negotiations, we had understanding. The deal was getting negotiated for several weeks or months or years. Finally, yesterday, in the meeting, we concluded that we are going to acquire the target company. But how we are going to do? Either we can give cash, we call this cash acquisition, cash buyout. There's something called leveraged buyout. I borrow and pay the cash. And or I do a kind of equity swap. So whatever the target company shares are there, their shares will be converted into my company's shares. Based on valuation, the ratio changes. If both the companies have the same value, 1:1. If my company is 2 times the value of that company, then the ratio is 1:2. For every 1 share of mine, or in their point of view, for every 1 share of the target company, they get the half share. Or every 2 shares of the company, they get 1 share, depending on valuations. Okay. So that's what I mean by I named it as a direct issues to target investors. In the first 3 cases, the investors are my own shareholders. My own means I own a company, my company shareholders. Then mergers and acquisitions, I have a target company shareholders, I will issue to that. Is it clear? Any questions on this? Okay. So some examples in the recent times. Rent the Runway issued 12.5 million. It's not that small. 12.5 million. There are many companies who come for public issues for this kind of amount. They issued shares to their own shareholders this month, August. We are still in August. Then Empire Petroleum in August. Nuveen Credit Strategies Income Fund. It is a closed-ended fund. I think we'll have these discussions in the last topic today in mutual funds. Mutual funds also issue the shares and they have done it for their own shareholders. And Google issued C bonus shares at 1:1. You remember A shares, B shares, C shares. Did we talk about this? Yeah. In the last week, we have seen in the asset classes types of equity. And I was trying to classify n number of types of varieties of equity shares. One is based on its class. Class A, Class B, Class C. Class A is issued to all, everyone is owner, all are traded. Class B, promoters own the shares, they are not listed. They are restricted. Class B. Class C, they are listed, traded, but they don't have the voting rights. Why Google did this? They don't want the new shareholders to stop their acquisition process. They didn't want to see that kind of restrictions. So they have issued C bonus shares. Okay. Remember, bonus shares are issued to whom? The existing shareholders. There is no new person. I already have Google shares. I'm getting more shares, but Google doesn't want to increase my voting rights. My voting rights are the older ones only. It didn't increase because it has issued C-class shares. Then stock dividend, I missed the date when Walmart issued a stock dividend. It was 4%. I think there is something called REIT. Have you heard about this REIT? Any one of you? REIT? Yeah.
That's the fund for real estate.
That's it. I think we'll have a small discussion on the mutual funds also, but quickly on that, REIT is a kind of investment company. It's like a mutual fund, but it is different from mutual fund because if you are interested in real estate, my interest is that, but you don't have that much amount. It is huge. Even if you want to buy a small 2-bedroom apartment, it will cost you $200,000-$300,000 minimum. So if you can't do that, I think you definitely can't do to buy a property which is a commercial property, big shopping mall. You can't do that. So REITs, what they do is they collect money and put their money in buying that kind of commercial properties. So you are a shareholder of that company, means whatever the capital gain, whatever the rentals as income you get, there you will also enjoy it. That's what you call it as a REIT. Some extent, this is not related to our discussion today, but I wanted to introduce so that you will not be confused. Stock split, reverse split. So stock split is something, you take Berkshire Hathaway. I think it is a highest price stock, maybe. Okay, I'm not known price more than that. I think a small person can't buy that. Okay. Similarly, when the companies feel that our stock is highly priced, let us make it available to everyone in the public, so that they can buy with their minimum or lowest possible investment. What do? You take Tesla. Tesla is around what? 300, 310? Say 310. If Elon Musk feels no, it has to go to small people, then what he does is he will make the stock available for 31. Is it 310 today? I don't see that. Can any one of you quickly? Yes. 3? 345? Yeah, 345. 345. So he wants to make it available to all of us for $34. Okay. So it does not mean that company's value is has crashed. No. What he does is he does the stock split. The stock split. What they do is they split the face value of the stock 10 times. 10 times, which means the market price will fall by 10 times. That is the idea. I just gave the example of 10 times. It could be 2 times or 3 times or something like that. But the objective is to make it more liquid in the stock market. Every company loves to see their stock getting traded actively. That happens when the price is low. That is a major motto of this. Then again, reverse stock split. Sometimes I think you can look at penny stocks. They're getting traded for $1, $2, or $3. I think stock exchange rules say that no, you're too small to be traded. Liquidity problem. Bid-ask spreads are very bad. I think you see that, right? So you have to go for reverse stock split. A company is getting traded for $1. What happens? It becomes $10. How? 10 shares become 1 share. Okay, that you called as company value didn't change. Company's earnings didn't change. Everything is same, but only the stock value is split. Got it? So I thought of, because sometimes when the new shares are credited, I hold 100 shares of a company, and suddenly it becomes 1,000 shares or 500 shares. I feel I got new shares. No, it is stock split. Which is different from bonus issue of stock or stock dividend. bonus issue of stocks and stock dividend, yes, number of shares are increasing, your value is also increasing. You become rich by new stocks. But in this case of stock split, no. Okay. So some examples on M&As. Twitter's acquisition of Telepart in 2015. Yeah, it was a new share of Twitter to, yeah. So it is a equity swap, we can say. It is not a cash deal. If it is a cash deal, we don't discuss that here. And similarly, another example is Disney acquiring Pixar in 2006. Okay, and finally, direct listing. It is not exactly the primary market, but something interesting. Owners of the company, instead of going for public issue and selling their shares to the public and going out of the company, they directly list the shares in the stocks, so that whenever they want, they can come out of the company in the secondary market itself. It gives them flexibility. I think these are all the issues we have in equity. And same is the process, but not this complicated when companies are issuing debt. We discussed this in last week. So, any question on this? All clear? All good? In that case, quickly go to discussions once. Open that. If you have a question, you can ask me. Yeah.
Chapter 3 assessment is due at 10 p.m. What's that?
Chapter 3?
Yeah.
It could be an error. That's not a problem. Don't worry. Don't worry. Yeah, go through the discussions. And by the way, it was very interesting to see your discussions in the last week. And most of you have preferred treasury bill. I appreciate that. And you have stated your reasons. So, and some of you have gone for commercial papers and CDs and so on. Yeah, those who wanted to invest in commercial papers, though retail investors cannot invest in that, you can do them with money market mutual funds. Get a fund which heavily invests in CDs, CPs. So you got the discussion? Could you see that?
I can see it, but this is like.
Give me a moment. Yeah, now you can see that. Please go through it.
Yeah, I can see it.
So you can pick whatever the issue you wanted, and I wanted your views in terms of the issuer as well as investor. I hope both can't be the same. you can ask me, no problem.